So we've had South African bonds trade softer today, again in line with the softer rand. Focus on today's economic data out locally, with South Africa's current account deficit having widened more than expected, as we said, in the first quarter to 5% of GDP from 4.6% in the fourth quarter. This where recent opinion polls indicated where recent polls have indicated growing support for Brexit, Brexit as well, seeing investors scurry to safe haven assets on the global scene, and the yield on the 10-year German Bund, which is Europe's benchmark bond, turning negative for the first time as well today. Joining us on the line, Wikus Furstenberg, Portfolio Manager at Futuregrowth, for more on what's playing out in that space. So, Wikus, thanks so much for joining us today. So let's take a look at the local picture first, because what's interesting is that we have seen economic data filter through locally, and that keeping investors on edge, certainly detracting from further investment in our bond market right now.
Hi, Alicia. No, yes, certainly. I mean, you mentioned the current account deficit, and I think the really big concern there is what's happening in the income account, where payments to foreigners actually sort of increase the net one. So clearly, we're not out of the woods yet, and most of the analysts, as you mentioned, expected an improvement in the current account deficit, and it's certainly not happening at the moment. The trade account doesn't look too bad, but I mean, for the rest, I'm afraid to say we still have some way to go.
And let's take a look at where concern lies primarily. It's in that income deficit, because what that points to in terms of foreign outflows out of South Africa, the South African market, is more so a structural deficit, and that keeping investors pretty jittery right now in particular.
Oh, for sure. I mean, we're all really excited about portfolio inflows and so on, but at the end of the day, there's going to be you can't have your cake and eat it. We've got to pay a price for that. So this portion of the current account deficit certainly becomes sticky and has increased over time, and I think in a way it's sort of created a burden on the current account, and clearly requires a very strong trade account recovery for the current account deficit to show a meaningful contraction over time. And you mentioned the structural deficit. I mean, we sort of did a calculation on our side. It looks like about 2% if you take that into account. So we need some significant improvement on the export-import side, both in terms of goods as well as services to offset this.
Wikus, what is interesting is that the activity we're seeing locally stands in stark contrast to what's playing out globally, with investors buying bonds as safe haven investments, even if it does take yields lower and into negative territory. And case in point, what's played out with regards to German government bond yields specifically.
Yeah, I think that, again, takes us to what's happening globally. Weak growth, the inability of policymakers to really sort of make a dent, including central banks, with negative interest rate policy amongst 5 of the developed markets already. We're not really seeing what we want to see in terms of better growth, and obviously it will have a negative impact on a small open economy like South Africa. We need the globe to grow, and that doesn't happen, then obviously we're seen as risk, and then you'll see our bond yields going up, as even though, as you mentioned, global bond yields are actually going down. Developed market global bond yields are actually going down, and in some cases into negative territory. I mean, you mentioned the euro area. Now we obviously know about Japan as well. So it's really it's a reflection of, it's really at the end of the day, it's about uncertainty, isn't it?
And that in itself highlighting how safety is trumping yield in some quarters. So talk us through the kind of activity then that played out at today's bond auction, Wikus.
Actually not too bad. I mean, there's 3 bonds on offer. I mean, all 3 of them sort of cleared at levels very close to where the market was at the time. And if you look at the cover ratio, for the 3, ranging between just over 2 to almost 3.5. So it wasn't too bad at all. I mean, so for some, clearly there's some value at these sort of levels, and we should also take into account, tactical drivers like coupon flows finding its way back into the market, and of course a big index change somewhere down the line in August of this year.
Yeah. Well, we've got the Brexit vote next week in focus. We've got this week the Fed's decision on interest rates. And for the most part, markets expecting things to be left steady. Because where do you stand on that front?
I think if you look at the Fed, firstly, it'd be very difficult for them to make that move next week. And I think that's exactly what is being priced by markets. If they do, it will be a surprise to the market, simply because it is really difficult for the Fed, and they've proven that, to be insensitive to what's happening globally. We obviously also had a disappointing U.S. employment report in May, although that's been offset by better retail sales and some indications of some inflation finding its way into the U.S. economy. But for now, I think that's off for next week. I think it's more about what's happening or what's going to happen closer to year-end and next. We still expect the Fed to continue normalizing policy into the end of this year and next.
Well, let's leave it there. Wikus, thanks so much for having joined us on the line this evening. Wikus Furstenberg is Portfolio Manager at Futuregrowth.